friends. Welcome to OAVA's weekly update on money and markets. We begin with big news for India's financial markets, especially the debt market. Last week, JP Morgan said it will include government bonds in its widely tracked emerging market bond index known as GBIEM Global Diversified Index effective from 28 June 2024. India is expected to reach the maximum weight of 10% in the GBI EMGD over a 10-month period starting from June 2024 till March 2025. The company also said that 23 IGBs, Indian government bonds, with a notional value of 330 billion US dollars are index eligible. India has also not provided special treatment of tax in terms of withholding tax, and investment will be under existing FPI route in India. This keeps level playing field between onshore and offshore investors and will further deepen onshore market as trading and settlement will happen in India. Most analysts and market participants expect that during fiscal year 2025, India can get inflows in the range of 25 to 30 billion US dollars from funds who follow this index and from other foreign active funds as well. This move is expected to increase the demand for government securities, lead to fall in yields, and deepen the Indian government bonds market, as well as lead to higher capital inflows and appreciation pressure on the rupee. In yet another important news on the Indian debt market, the government plans to sell 50-year maturity government bonds for the very first time as part of its borrowing program for the second half of FY24. The new 50-year bonds, revealed in the borrowing plan released by the Reserve Bank of India on 26 September, will add to the 30-year and 40-year tenor bonds that are being offered currently. The government plans to sell rupees 30,000 crore worth of 50-year bonds in the October to February period. Overall, the government is sticking to its plan of borrowing rupees 6.55 lakh crores for the second half of the current financial year, or 42.45% of its gross market borrowing program of rupees 15.43 lakh crore for the full year. Moving on to news about the equity market, foreign portfolio investors, that's FPIs, have pulled out over rupees 10,000 crore from Indian equities in the first 3 weeks of September, primarily due to rising US interest rates, recessionary fears, and overvalued domestic stocks. Before the outflow, FPIs were continuously buying Indian equities in the last 6 months from March to August and brought in rupees 1.74 lakh crore during the period. While some analysts feel this trend can persist as US rates are likely to remain high for longer, others feel strong economic growth prospects of the Indian economy can continue to lead to foreign inflows in coming months. Moving on to news on important listed Indian companies, Moody's Investor Services, a global credit rating agency, has downgraded the corporate family rating, that is CFR, of Vedanta Resources Limited, the parent company of India-listed Vedanta Limited, over elevated risks of debt restructuring over the next few months. The downgrade is from CAA1 to CAA2. Additionally, the rating on the senior unsecured bonds issued by Vedanta Resources Limited and those by its wholly owned subsidiary have also been downgraded to CAA3 from CAA2. Outlook on these ratings has been maintained as negative. According to Moody's, Vedanta Resources Limited has not made any meaningful progress on refinancing its upcoming debt maturities, particularly the $1 billion bonds that mature in January 2024 and August 2024. Vedanta Resources Limited's concentrated ownership with the sole shareholder, Vulcan Investments, keeps the risk elevated for related party transactions to the detriment of creditors. In addition, several senior management departures in recent years pose risks to continuity and stability of its operations, Moody's Investor Services wrote in its report. Post the news, shares of Vedanta fell 6% during the week, touching a 2 year low. And finally, we end this week's update with news on an upcoming interesting investment avenue: real estate fractional ownership. Fractional ownership of real estate is gradually gaining acceptance among investors as assets under management have touched rupees 4,000 crore, according to a recent report. Many private companies have set up fractional ownership platforms that allow investors to own a fraction of real estate assets. Fractional ownership typically involves the ownership of an underlying real estate among multiple investors. This lowers capital requirements and facilitates participation of a larger set of players in real estate ownership. Although the concept of fractional ownership of real estate is at a nascent stage in India, it is expected to grow in the next few years, aided by tech driven platforms. Some of the prominent players in this space are Bengaluru based Yours, HBits, Meyer Capital PropShare, Yield Asset, Asset Monk Strata Prop, and Prop Returns. That's it for this week. Do click like, comment, and share if you found our update useful. And do visit our website www.oava.in for information on our courses. See you next week.